Welcome to ESGX Live, the community for education and information to inspire collaboration and action to help build a stronger and more resilient community and society. This week, we're talking about greening your retirement plan and indeed possibly greening your retirement more broadly. And just as a very brief introduction, let me talk through a couple of the things that you may not have seen in that pre-roll. Firstly, this really matters as pension assets and saving or retirement plans are a massive pool of funds around the world. So, lots of different measures. This one from the OECD, I think, is something like $33 trillion. Now, that's the largest pool is in the US, but there are other pools offshore that are very substantial in relation to the size of those economies, particularly countries like Australia, Belgium, Denmark, etc. And so those are quite significant. Just to put these in context of GDP, the bars here show the savings pools in those countries as a percentage of GDP. One of the things, to jump right to some of the answers I hope come out of the discussion today, that is super important, is that we still have ESG and sustainability as somewhat of a fringe activity. It is not mainstream. And I think back to the beginning of my career when there weren't cash flow forecasts being used to value businesses. There wasn't value at risk being used to understand banks. These things are all completely in the mainstream now. And of course, we'd love to see that happen. It is starting. We have businesses like BlackRock talking about this being incredibly important. Businesses like Federated in the UK, industry funds managers in Australia, etc., all who are on this kind of a path. But we want this to enter the mainstream. And of course, it is important because there is so much going on in the world which we need to see change in terms of climate change. We need action off the back of that. So with no more ado, I will hand over to Paul Herman to take us into a bit more detail and introduce our guests.
Great, thank you, Nigel, and thank you everybody for joining today. It's the month of July, which is the new year for tax day here in the US. Tax day is a week from tomorrow, July 15th. So remember to have your taxes filed. Make sure and make your contributions to your IRA if you need them. And we're going to talk today about how you can green your retirement, green your 401k, and green your IRA. Nick's going to tee up some slides that I can talk through, and then we'll turn it over to Megan and the panel, including a deeper discussion from Chad Spittler on what is ESG impact and sustainable development. So when we talk about greening your retirement, we usually start with this slide. On the right side is closer to utopia. On the left side is closer to dystopia. So we're all headed for that right side, which at HIP, we think about things on a rating scale, and that's 100 on a 100-point scale. So on the next slide, you may be asking yourself this question today. If your work and your life are sustainable, can't your portfolio and your 401k or superannuation plan be fossil free? And the answer is yes. So meet Kristen Magnuson. She's a lead architect. She's an architect and lead AP at Stoke, which is a building consulting and advisory firm that also enables employee engagement from healthier buildings. And Kristen, in addition to her kayaking and her architecting at work, wanted her 401k to be sustainable. And that's something that Stoke has done now for 7 years, and so it's completely doable. And we're going to talk about some of that during the discussion today. On the next slide, one of our guests today is from Natixis. This is a Natixis survey, and what it shows is whether you're a man or a woman, whether you're young or old, that most people, more than half or more, usually 3/4 to 80% of people, want their retirement investing to be sustainable. So as we see on the next slide, and as always, these slides will be available on ESGX for you. Morningstar has shown that sustainable, impactful funds can outperform. Fiduciaries of retirement plans are usually seeking to reduce risk. A retirement plan is an entity that can get sued. Sometimes when they do things that aren't in the fiduciary's best interests, that's a legal risk. But one of those risks is actually not sustainable funds. So 2/3 of the time, sustainable funds outperform, as you can see here in 2019. even in allocation funds that are a mix of stocks and bonds, it can be up to 84% of the time. This is for the year 2019. So on the next slide, as you'll see, there's tools that you can dig into. So please check out, and we'll give you a quick tour of fossil-free funds, of cleanportfolios.com, and of course at HIP Investor. And so on the next slide, what happens at fossilfreefunds.org is there's a mix of ways you can look inside the fund. So As You Sow, which is a nonprofit based here in California, has unpacked those funds for what's inside and looked at it from a fossil, a gun, a deforestation, a tobacco point of view, as well as gender equality. And what may be in your portfolio on the next slide is the S&P 500. And according to As You Sow's scorecard about investing with your values, you can see that fossil fuels rates a D. There's actually quite a bit of fossil fuels in there. Gender equality rates an A. So on a relative basis, the S&P 500 might actually be better for women than other funds. And tobacco and military weapons get an F grade. And there's details on the As You Sow tool on the next page where you can see that Berkshire Hathaway and Exxon and Chevron, as well as Dominion Energy, are in an S&P 500. But that's usually what we get encouraged to invest in our retirement. So on the next slide, there's a tool called Clean Portfolios as well. You can go there. It's free to sign up. On the left-hand side is a 401k. We've loaded in 401ks from Amazon and Microsoft and Google, so you can see what's there. We talked about Stoke already. You can see what's in the Stoke plan. Or on the right-hand side, you can build your own portfolio. And we've done this at HIP Investor with cleanmoney.us. So on the next slide, you can see that Google has about $7 billion in their 401k plan. But the average fossil fuel exposure across all of those funds is about 8%. And only one of those funds is specifically focused on being socially conscious or sustainable. And this is the challenge all of us have in our 401k plans. How do we make our 401k plans or superannuation plans more representative of the future we want to live in? So on the next slide, what you'll see is that most of these plans, like Vanguard, have a little to a lot of fossil in them. These are the target date funds that are the usual defaults. And on the next slide, what you'll see is some additional funds that you might find in your plan as well. And nearly all of those are full of fossil fuel companies. The only one that's not is a real estate company, a real estate fund, the Vanguard Real Estate Fund. So on the next slide, what you'll see is a way to look at your whole portfolio. This is an information layer that you can put on top of this. Chad Spittler from Third Economy is going to talk about this as well as to different ways that you can evaluate your funds. And on the next slide, what this has done is many young people don't invest. And what has happened at Stoke when Kristen Magnuson said, let's make our 401k fossil free, it used to be that 1 to 2 out of 10 people at Stoke invested in their 401k. And since then, since they've made it more sustainable, 9 out of 10 or even 10 out of 10 have invested. And that 103% is not a typo. That means that the alumni of Stoke have kept their money in the plan, at least for 2018. And so when you design a retirement plan that has these characteristics, it can be very sticky. And you can also see that 75 to 95% of the employees at Stoke have actually invested their dollars in a fossil-free way. So we're going to get ready to turn it over to the panel. Megan Morrice is going to host us today. So Nick, if you could turn off the slides. And so Megan has just finished up a chapter on investing for sustainability for the new global handbook on impact investing coming out from Wiley this year. So I'm going to turn it over to Megan, and Megan's going to introduce our esteemed panel, and then Chad Spittler of Third Economy is going to give a short overview, and then we're going to have a deep dive discussion. So please ask your questions in the chat or the question box, and we're here to create some education, some inspiration, and hopefully action. Over to you, Megan.
Okay, great. Yes, as Paul said, I recently wrote a book chapter on this subject, so it is definitely something that is near and dear to my heart. I also am the head of operations for Values Advisor, which is a service that helps connect financial advisors that care about sustainable investing with clients. And I am the lead ESG consultant at EQIS Capital Management. So to start out, I would like to have, as Paul said, Chad Spittler, the founder and CEO of Third Economy, just give us a quick self-introduction to start us off.
Hi, Megan. Thanks, Paul. Hello, everybody. I want to thank Paul for partnering with me on the slide that, if we can pull that up, please. There's a problem that we're all facing right now. And for those of you that have been listening since we started, you're going to see and hear a lot of different terms. And the fact that these terms are often opaque or misunderstood is really a limiting factor in the growth of the sustainable investment field. And I'm of the view that if we can have a better understanding of what these different terms mean and how investors use them, then we'll start to see more money moving into sustainable investments. So I got together with Paul and the team at HIP, and I said, Paul, let's come up with a methodology that we can bring to the market that really brings some clarity to what are these different terms that investors are throwing around that not everybody might understand. And I certainly have seen that in the recent DOL guidance around ESG, where they are confusing values-based investing with ESG analysis. So the acronym that we've come up with here is VIA3. VIA3 is the way to a third economy. That's my company, and to us, a third economy is a sustainable economy. So these are the tools that are available to investors to invest sustainably. So we use sustainable investing as the broad term here. Values-based investing is really based on legacy, socially responsible investing was the acronym that was most often known and this field started with, which was avoiding things that were inconsistent with your morals or your ethics. And that's still a tool that's available to investors today. Values-based investing or socially responsible investing is an important tool available to us, but often confused with things like ESG analysis or impact investing. Impact investing is really about the consequences that your investments have on the environment and society as derived from the products and services that the investment company creates. Different than ESG analysis, which is really more about how those factors relate to financial value, and in my view is more about how companies manage their operations, versus impact, which is more about what are the consequences. There's two other important tools that investors have available to them. They have the tool of activism, now often being called investment stewardship. This is really about engaging and voting, and how do you use your rights as a shareholder to affect change at the companies that you're invested in. And then there's also a trend towards aligning with the Sustainable Development Goals of the United Nations. So what Paul and I have done is we've aggregated data into these 5 categories and are rolling out a rating that will allow you to assess your portfolio, mutual funds or ETFs from these 5 perspectives, again, with the objective that we are bringing a common language and a common framework to help everybody understand how these are used in the portfolios that you're invested in. If you could go to the next slide, please. Here's an example of how, back one, thank you so much. Here's an example of how this pans out as applied to one of the funds that we've rated, the Calvert Equity Fund. So if you could go to the next slide, the rating system here is a simple green, yellow, red. If it's highly rated in that area, it's green, medium, moderate, yellow, and if it's low in that area, red. And so the idea here is that we can apply this common language and color coding to these sustainable investment principles to quickly give you an understanding of in what ways your funds may or may not be sustainable. So in this particular example, they're using extensive negative screening. So lots of values-based considerations in the portfolio construction. The impact and the analysis are moderate or medium in the sense that not a big differentiation in our ability to assess the impact that this portfolio has relative to an S&P 500 fund, or the ESG quality of the underlying portfolio securities. So that yellow basically means that impact and ESG analysis are at benchmark, so relatively same as an S&P 500 index fund. But the fund manager is using the tools of activism to the benefit of shareholders. They are engaging in voting, and they are aligning not only the fund with the United Nations Sustainable Development Goals, but also the firm. So I call this similar to, do you buy your organic apples from the food co-op, or are you buying your organic apples from a conventional grocery store? So these concepts that VIA 3 represents will hopefully set the stage for us to be able to have a dialogue where we're all using the same terms and have an understanding of what those things mean.
Great. Thank you so much, Chad. And now I'd like to, again, introduce the rest of our panelists and have everyone do a self-introduction, just talk a little bit about, why they're here today, tell us a little bit about their professional background as well as their company. So Brian Mcdonald is the Director of Retirement Services at EQIS. Paul mentioned some of their data in the first slide. Brian, would you like to give us a quick introduction of yourself?
Yeah, thank you. And hopefully everybody can hear me. I've been on a million of these Zooms, but I somehow seem to screw up the audio every time. So yeah, I work at EQIS Investment Managers. I've been there 10 years. We're your traditional financial services asset management company. And I like to tell this story that, when I started there in September, so just short of 10 years, but 10 years ago, we didn't have any sustainable investing options whatsoever. And now, 10 years later, the number one push and number one priority at our firm is promoting and getting the word out about the sustainable investments that we do have. So about 5 years ago, we acquired a manager from Europe called Maura. They've been doing sustainable investing, ESG investing in Europe for 30 years. And then we created the industry's first ESG target date fund just over 3 years ago, which is something we're really happy about, really proud of. If you don't know what a target date fund is, it's designed for corporate 401k plans. It's more of a set it and forget it. You pick the date that you're going to retire, and you select that vintage that correlates with that date. It's something that, as we're going to talk about today, there's $8 trillion in the corporate 401k space, and less than 1% of that is in sustainable options right now. They estimate that it's going to be up to $11.5 trillion by 2022. So this is a large asset pool that all sustainable investment managers are not getting their hands on, and all of us on this Zoom need to change that. I think we can do a lot of good with that money and get that money in the right hands, as we're going to talk about today. Just to go back quickly on those survey results, those results were great, and they're fantastic, and they really highlight what people want, normal people who work for a normal company, how they want their investments to reflect their values, how they want social change, all those different things. But I would say I'd love to get new survey results at EQIS, because I think certainly, COVID has made people either look at their company in a really positive way, like, wow, I love working at this place, they've treated us really well, or you've kind of seen some cracks in the armor of the company that you worked at, or that company a bunch of people off, unfortunately. And then obviously with all the social issues that are happening, I think 70% of people say they want their investments to reflect their values socially. And I would assume that that number has also changed with the things that have been happening recently. So I'm really, interested to see how people's views. COVID was an awfully terrible thing, but from our perspective, in terms of our investments solely, it really proved that ESG worked, because ESG, not just us, all ESG managers have outperformed the broader market during this downturn and during this period of unrest. So I'm really looking forward to the conversation today. Thank you.
Great, thanks, Brian. And next, I would like Judy Morrice, who's a financial consultant and the former Deputy Assistant Secretary for the U.S. Department of Labor, to give a quick introduction.
Well, greetings, everyone, and thank you for having me on. I spent most of my career as a Chief Investment Officer managing U.S. corporate pension and retirement 401k plans and large companies, mostly Fortune 100 companies. But bookended at the beginning and end of my career, I do have show and tell. At the beginning of my career, I authored this working paper for President Carter's Commission on Pension Policy, and it was titled "The Use of Pension Fund Capital, Its Social and Economic Implications, Some Background Issues," authored in 1979. In 2013, I went to work for the US Department of Labor, the regulator for those of you in the US, on US corporate retirement plans, and was very involved in guidance, in reviewing the guidance that had been written to date and helping to author the guidance around ESG investing and retirement plans. So it's an interest of mine that has spanned my investment career and my career as a regulator. So happy to be here.
Great, thank you very much, Judy. Next, I'd like to invite Doug Lyman, who is the principal and a financial advisor of Longview Asset Management, to give an introduction.
Thanks, Megan. My name is Doug, and as Megan pointed out, I'm an investment advisor, and I work primarily with building environmentally and socially responsible 401k and 403b plans. And I actually built the very first all ESG 403b retirement plan for a nonprofit. I'm also an author, show and tell time. I wrote a book called From Monk to Money Manager because I was a Benedictine monk for 20 years before moving into finance. And then I also founded the ESG Fiduciary Institute, which is designed to align fiduciary duty and ESG investing principles, because we need to protect the future that we're investing for.
Great, thank you so much. Next, I'd like to invite Maura Bunn, who is a non-executive director at the Australian Ethical Investment Company, to introduce herself.
Thanks so much, Megan. And it is such a pleasure to join you all from the hinterland of Queensland's Gold Coast, where the sun is rising. I sound very American. I'm actually Brazilian, but I went to Williams College undergrad and started my career at Morgan Stanley, first in the M&A department and then in their technology group in San Francisco. From there, I wandered the world, very eclectic, worked for the World Bank in Nepal, 10 years in the community sector here in Australia, leading finance at Greenpeace, lead advocate at our version of Consumer Reports, which is called Choice, went back to finance, research, many things, but over the last 10 years or so have really focused on impact every which way, particularly around climate and nature. And so in 2013, I joined the board of Australian Ethical Investments, which is a very unique case study. It's a 30-year-old company that listed early with deep green roots, founded by hippies, really. But they had the vision of setting up a charter, which is our kind of Colonel's secret recipe. And it's a little bit more than do no evil, listen up, Google. It has some real clarity around planet, people, animals. And we have a very strong ethical research team that creates frameworks around different sectors for investment. Those frameworks lead to a retirement savings, offer, which here in Australia is unique. We have, I think, depending on the day with volatility, $2 to $2.5 trillion of retirement funds under management, because it is a mandatory savings system, and choice is allowed. And so we have become the fastest growing, what we call superannuation retirement savings fund in Australia. And here's the most exciting thing. It's not about compromise. We are leading not just on the story of a positive future, we are leading in investment performance. It turns out the fiduciary responsibility is entirely aligned to a positive future.
Great, thank you so much. And I'd like to open this first question up just to all of our panelists. What would your advice to somebody who is ready to take their existing retirement portfolio and make it more sustainable, have more social and environmental impact? If somebody wants to do this but is brand new, what would some of the first steps you would recommend to them be?
Can you give a little more context? Do you think on the institutional level or on an individual IRA level?
You can answer it either way. Doug, why don't you start on the institutional level? Let's say you do have control over the retirement plan and this is something what you want to do. What would that person do?
Yeah, well, I think the first thing to do is obviously you need to talk to your human resources department and your the CEOs who are leading the organization. And one of the things I've found really helpful is to make them part of the team and part of the effort, and not make it an adversarial relationship. As soon as you walk in and say, storm the gates, we're gonna fight the system and fight the power, you're going to make enemies and you're going to get resistance. So to bring them, as I always say, that remember, everyone has two jobs. One is the job that they're listed to do, and the other job is to make their boss look good. And so you want to try to make your bosses look good in this process and make sure that you're trying to align the investments with their values and make it really a team effort. And when you do that, it goes very smoothly. When you make it confrontational, it can get very tricky. So to be able to start by asking how we might be able to add funds, we've got some great panelists here who have some of those funds, in the EQIS and things like that. There's some great resources out there that you can add just by adding. It takes almost no effort to add extra funds to the plan. And it doesn't cost anything to do that. So asking for more choice, asking for more options and more freedom to invest according to your values is really easy to do. And I think it's the first place to start. Make sure you have the right funds in the plan. You need to do a little homework to do that. I'm sure all the panelists have suggestions on what those funds might be, but it's not hard. It just takes a little bit of effort and mindfulness to get it done.
Great.
Yeah,
Thank
I would echo that. I think, as my job is to go out and meet with people like CEOs or HR professionals who do control their company's 401k plans, I would say for a CEO, it's probably most of the 22nd thing that they're thinking about on their to-do list. Their company's 401k, unfortunately, is not their number one priority on most days. And I think if you can portray a message of letting them know why it is important and not saying it because for your benefit, but for their benefit, as Doug was saying, that you can attract younger millennial employees that want to work at your company by offering these type of things. I just had a conversation with the person who runs Caterpillar's 401k, like the big Caterpillar company here in America. I mean, that is not an ESG company, and they're realizing it. And they're realizing that if they're not going to get smart, young, ambitious kids to come work for Caterpillar because they're not going to see a future in that, they're realizing they have to change their ways. They just bought a small solar company. But I think relating the story that way, that they've got to attract and retain some of this young talent for their company to be successful. And as Doug mentioned, then speaking of, it's not a long, complicated process that they have to jump through hoops for. It's a rather easy, shockingly easy process as well.
Megan, can I throw in just a quick perspective on that? I agree with Brian and Doug and encourage the edge of, boisterous behavior. And we see that mostly with tech giants, where massive advocacy groups of staff at Amazon, Apple, Google, Microsoft have put so much internal pressure, basically saying our talent, right, is your core IP, our values need to guide the future. And we were all stunned in Australia when Microsoft released its climate policy in January. World class. If everyone did what Microsoft did, we would have a shot. So the power of staff, that positive discussion with HR actually can be, a little bit cutting because it really is important for talent.
Great.
Megan,
Thank you.
if I might just offer a slightly different perspective, having lived in big corporate America and recognizing that it's not easy to change a fund lineup. It's possible, but it's not easy. And I would argue that one of the things that we need to arm everyone with is the data that shows that our ESG funds add value relative to their benchmarks, because that's going to open the conversation with the finance arm, who in fact have to evaluate and select funds. And there's a hangover from the days of old when we had exclusionary social policies, and large corporate America hasn't gotten over this hangover that thinks ESG funds are of that ilk and underperform. So first thing we need to do is reinforce the conversation we've had about the common language. We're not talking about social investing. We're actually not talking about economically targeted investing. We're not talking about impact investing per se. We need to get our language right, and we need to arm our askers with the data about performance. I would also say if I was going to ask for an additional fund and the answer is it's too complicated for the fund lineup, then I would say give me a brokerage window so that I can select funds on the platform that meet my values, and it's my fund, and you need to give me choice that allows me to act, because it does take a while for those in corporate power to understand that they actually already do ESG investing and don't know it. Their traditional managers don't talk about how the factors that influence evaluation in corporate life and of corporate assets include sustainable factors, because you can't know if they're material if you don't ask. So A, they don't know they're already doing it, and B, they don't come armed with the data that shows how funds outperform.
Great. Thanks, Judy. And to take a question from one of our attendees, Holly Kaufman said, how do I decide on a good financial investment advisor and help me create and maintain my portfolio? I know about HIP, NIDA, Perio, RBC, Ethos, and others. Don't know how to compare services, products, fees, and performance. So she doesn't specify if she's looking for a financial advisor to help her for a retirement plan for a company or her as an individual. But since we are focused on retirement plans, does anyone have just some good tips on how to find what professionals you should be seeking to help you on this journey?
Well, it's kind of my wheelhouse, but I'm biased because that's what I do for a living. So call me as maybe the simplest answer I can give you. I'm happy to build it for you. But more specifically is you need to make sure they're a fiduciary first and foremost. They're willing to take on that fiduciary duty for you. And so fees can vary wildly. So you need to be mindful of those fees. But if they're willing to take on that fiduciary responsibility, you're likely to have I can't promise you're going to have a great experience in terms of customer service, but it's a really good first start. I'd also look to see if they're a B Corp. That's a great way to check to make sure that they're aligning their business practices with those values. So those are two quick metrics, I would say, to help you start the conversation.
Great, thank you. And
I would actually like to offer a perspective on that, if I might. Yeah. Having worked with an array of financial advisors ranging from small firms to large firms, all of whom, given my background, I know would be fiduciaries, one of the things I might suggest to anyone as you meet with a potential advisor, if they don't have a conversation with you about your values, they are not likely to design a program that meets your values. They may design a very good program, but we need to train advisors, and you need to work with an advisor that understands what you want to accomplish with your investment portfolio. And doing well and doing good requires a lot of questions to know what that really means to you And I wouldn't work with anyone that didn't ask me all those hard questions.
Great. Thanks, Judy. A lot of the panelists have mentioned lots of different tools that you can have in your toolkit and different ways to approach this. So I would like to highlight from Patrick Sieb in Australia. He is focused on investing in climate tech early stage startups. And his question is whether funds or pension plans can have a bigger influence by being activist shareholders or by divesting. So we had some examples of companies that did divest their 401ks from fossil fuels, from guns, but do any of the panelists specifically for retirement investments have a feeling on that question?
So Megan, as it's coming from Australia, and I don't really understand the state of shareholder activism in the US at this stage, but it is rapidly entering mainstream here in Australia. So there is a group called the Australian Sustainable Finance Initiative. It includes all of our banks, pension funds, insurance funds. It's aligned to the UN system. It is having huge impact on shareholder votes. So our large fossil fuel companies are now confronting over 50% votes demanding pathways on Paris commitments. And within the pension system, which here we call superannuation, absolutely options are coming up that are fossil fuel free. All of Australian ethical investments portfolios are fossil fuel free, but not just that. We now have publicly transparent decarbonization pathways, and the funds are outcompeting each other on how decarbonized their portfolios are and lifting the ambition on covering, as Microsoft did, what are called scope 3 emissions. So not just the energy you use as an organization, but the actual pathways of your investee companies. And this debate came closest in terms of influencing other companies when one of our large domestic listed energy companies called Woodside Energy, very large gas, some offshore petroleum, confronted an over 50% vote demanding from shareholders pathways to Paris. And this is a company that's trying to open new LNG and real contest on capital expenditure. So it is possible, it is happening, it is mainstream, and I cannot tell you how quickly this advent has taken on. It's no longer, kind of a sideshow, it's the main show at our AGMs.
Great, thank you. And Brian, were you going to say something?
Yeah, I was just going to say that I think, I don't know if he was asking divesting or activism, and I don't, and this is just me speaking, I haven't done any research on this, but I think both methods can be very effective if the organization has enough money that when they take that money out, it's a big deal to that company. Or if they're pushing a certain avenue, if they're powerful enough, I think they can, both ways can definitely influence change, but I don't have any hard numbers or anything to back that up.
I do have an observation. It is very clear to me that activism works. Why else would the SEC be working on methods to limit activist proposals? Why else would the Department of Labor not only have regulations about fiduciary duties with ESG, but fiduciary duties relative to activism and using corporate assets to be an activist? So my conclusion is it works.
I agree. I think that the shareholder activism aspect is really important to consider. And that's why understanding who the voter is, because if you're investing through your 401k plan, most likely there is an institutional investor who is conducting the voting on your behalf. And so understanding those voting records is key to knowing if that investor is representing your interests on this topic. Conversely, I've seen many clients who've decided that divestment is the right approach for them. So I think it really is a personal choice. What is your correct tool to represent your interests. And the thing I would point out about the divestment option is the portfolio divesting from a values perspective? So say, for example, I've worked with environmental organizations who, irrespective of the financial aspects of divesting from fossil fuels, have an ethical issue with them and are divesting for ethical or moral reasons. But there are plenty of investors who believe it's also a bad ESG play, that oil in particular, fossil fuels, are not financially sustainable. So that will hopefully give you a sense of some of the different factors to think about in the divestment versus activism debate.
Great, thank you. And to clarify, Patrick did add that CalPERS, for example, was more focused on activism at the board versus divestment, and he was wondering what was more effective. So the follow-up question is, what scale does the fund need to have to be of influence?
It's a fascinating question. I agree with Brian's comment that if you have very large scale, then board pressure, public pressure on activism without divestment can have a big impact. But there is here in Australia a very live peer-to-peer power base that's growing. And it grows through a nonprofit called Market Forces, which is leading the shareholder activism kind of from the peanut gallery. But what we have understood at Australian Ethical is by supporting resolutions, we have very nominal holdings in companies that we don't invest in for our funds, but we use in order to lead activism at AGMs. And as a very small player, suddenly very large funds are following on votes. So it's not clear that activism can't work with divestment, if you know what I mean. And both can be powerful, but one thing is very clear. Despite all this good news I share, our energy model remains 70% coal. And if we don't shut that down soon, the bushfires you all saw this summer are going to repeat, and they're going to take up half our year, not just the summers. And so, this really is quite, the science is telling us the exponential change we see when Tesla takes 10 years to knock back an entire car industry. We need to unleash that exponential technology on the solutions and strategies on investment. And the good news, Judy, I think is, in finding that balance of, understanding the language of economics and financial performance, just encourage people to open up 5-year share histories of big energy companies and compare them to big tech companies. Boom.
Great, thank you. Another question from our attendees. Steve White asks, can you achieve a very high percentage positive ESG portfolio without sacrificing diversity?
Yes.
Do we have any counter opinions on the panel?
I mean, we could talk about that all day, but the simple answer is yes. I mean, as a fiduciary running a plan, you have to balance risk, return, and cost, and the way you mitigate risk is by adequate diversification. So if you can't achieve adequate diversification, then you wouldn't be able to implement any of these ESG strategies as a fiduciary, and we're able to do it very successfully, so it's not a problem, no.
I thought the question was going to be, are you sacrificing performance? Because that's the one that I feel like is the big myth that is still out there these days, that back from the 80s, that, oh, that's nice, you guys are trying to do some cute little investing over there, but you're going to sacrifice performance. And I think a lot of people that are on this panel and at this meeting have seen and proven that that's just not the case anymore.
Brian, have you seen, let's say over the last 4 years, that myth has remained persistent, or have you seen more people that are educated on the data that's out there on performance?
I think it definitely has flipped. Not as much as we'd all like, honestly, but I think it's definitely something that is flipping, and ourselves and others are proving it. So you can go with the numbers and just show them, like, this is what we've been able to do. And then, as I mentioned earlier, this downturn with COVID, if you would Google news ESG, I mean, everybody was talking about ESG and the way it outperformed during this downturn. So I think, you know, a lot of the financial industry right now in terms of advisors are guys who, or girls or females, built their business, you know, 20 years ago and maybe are a little bit stuck in their ways, and we need more people like Doug entering into the mix and saying, no, this isn't the way it has to be. You don't have to just invest in the way that, you know, you learned from your Merrill Lynch training program in, you know, 1981 or whatever it was. So I think there's a lot of young guys and girls out there who I've talked to who are building their whole business off this. It's not just something that, you know, they're doing as a financial advisor on the side. Literally, their business model is to show people that they're doing sustainable investing and to try and grow their practice that way.
Great, thank you. And Robin Gilroy in Canada is asking if there are studies that compare cost of investing in various categories of sustainable portfolios. They say in Canada, we have to identify all costs, and it becomes difficult for advisors to add investments that have built-in costs as regulators look at them as double dipping.
Happy to jump in on this one as well. So that is one of the struggles with ESG investing, is you're going to add additional screens, so it's going to add additional costs. So your mutual fund ratio, expense ratios are going to go up a little bit. But the rule with, but on the upside, you also can get a higher expected returns. So it's risk, cost, and return are sort of three legs of a stool that you have to balance as a fiduciary. So yeah, your costs will go up, but you also can reduce your risk, because, you know, we've seen not only do ESG investments have the potential to outperform, they do it with less risk. And so that's a really key factor. So yeah, cost is one factor, but decreasing risk is a plus, increasing performance is a plus. And then when you balance all of those things out, then I think you really have a very competitive portfolio and competitive platform. So that's the rule, is the whole plan or your portfolio needs to be competitive. And so can we make a competitive plan or competitive portfolio? And the answer is absolutely. And we can often, and given how high some of the fees actually are in the industry, you know, we've built plans, all ESG plans, that have the total plan costs, even with the ESG extra sort of screening factors and fund ratios, still lower than the national average for plans of that size. So we're still safe in terms of the DOL rulings and in terms of any legal issues. So yeah, it is a factor, but it's one factor, and it's a multi-factor, multi-variable analysis that you need to do when you're analyzing the total portfolio, and that's just one of them.
And Megan, I don't know if it's possible to share the announcement that Australian Ethical made to the stock exchange here in Australia yesterday. One of our funds, which is an emerging companies fund, invests in small caps that are, you know, aligned to future industries and entirely divested and so forth on fossil fuels. We achieved a 13.9% after fees return. And that was compared to the ASX 200, which here is like the S&P 500, which had a negative performance for the year ended June 30 of 7.4%. Now, it is a challenge because, of course, we have active ethical screening. We have, you know, very active investment management, but our after fees performance is proving to demonstrate the value. Interestingly, we topped the entire regulated My Super, which is, you know, the pensions that are comparable in terms of balanced risk return. We had the highest Sharpe ratio. I think it was from December. So our risk adjusted returns are also very strong. One of the real challenges, and I think this is going to be a universally important one, we need exposure to unlisted equities. We need exposure to those early stage clean tech companies, the new food industries. They often are very risky. They're very expensive to get into. It's a very you know, different kind of risk. And so we need to work with asset managers that understand that risk. It does increase our fee exposure. Because it is, you know, venture-like in some cases. all of that is now required to be disclosed in Australia, I think around the world that's coming. And so, you know, the challenge there is to just understand where the quality partnerships are to gain that exposure and to balance it. So it's not too much, but also not underexposed.
Great. And pinging off of what you just said, in the US, the DOL just announced guidance to encourage more investing into private equity within 401ks and defined contribution plans. So for the panelist, is that something that you think could be a great way to increase impact investment within within retirement plans, or do you have see any potential negatives there?
I can speak from my experience, is that it's been difficult in 401k plans to put private investments because you have a class conflict. You start and you need to stay with it long enough for that private investment to generate liquidity for your exit. And that then we have issues of, does everyone have access to that opportunity, and how do we get equal access? It's one of the reasons why it's been so long coming. So that it does have complexities that go with it, but it's encouraging that the Labor Department is not discouraging this, but encouraging and allowing. And we'll find solutions to that challenge.
I would just touch on that. Something that I've kind of found, and I don't want to hijack this because I know this is an international call and Judy's got a lot to say on this topic with the DOL ruling with ESG in the States here, is that I do find it a little bit ironic that private equity, which is generally more complex than ESG investing, is A-okay to use, but there's a big holdup with ESG investing in 401k plans. So it's kind of, I know what, I think it's great. It's great. Private equity, awesome. But the fact that ESG is out, there's a disconnect there somewhere with that whole thing.
No, it's insane, Brian. That is the disconnect.
Yeah.
It was seriously, is literally insane. My great hope is that the power of corporate America on the front end of innovation and, you know, a positive future, not the back end, is just going to influence that. We have to, you know, have confidence that crazy politics in America, Brazil, other countries, they are temporary blips, and our institutions are strong enough to withstand them. And when you see what's happening with the Reserve Bank, you know, Fed leadership around the world, and, you know, this really sharp understanding, our economy tanks by the end of the century unless we address the climate issue. And that's coming out of the financial regulatory system globally. That will ultimately have weight. And those kinds of short-term politicized decisions will be seen to be ideology as opposed to science and economics.
Great, thank you. And that being said, Judy, you've mentioned a little of this, but would you like to speak to some of the differences in the last few administrations from the time that you were at the DOL to what you see today?
One of the things that you find as a common theme when it relates to ESG investing, and I'm going to use that term to encompass what I think we're trying to talk about today versus ETIs. If you look at the Department of Labor guidance, they are consistent in saying, as a fiduciary, you need to look at the financial factors in guiding your investments: risk, return, cost, diversification, consistency with an investment policy. In Republican administrations, they try to scare you away from considerations of ESG factors and make you put a hurdle up that suggests that you've got to, that it's something abnormal and we need to do extra amounts of work to defend. In Democratic administrations, there's a recognition that's it's embedded in the fabric of our economy, and they try to take the constraints out of the way. And in the US, we don't have a fiduciary force that requires consideration of ESG factors, which is different than some of our global counterparts. So we're now in a Republican administration that's trying to scare us away from ESG investing. And it's clear by the proposal that they've cherry-picked the facts, so we need to correct the record. I would encourage anyone who has a pen to write a letter to correct the record on ESG funds performance, diversification, cost, and appropriateness. B, they're trying to put an extra burden of process burden on documentation, but it's so unclear as to what we need to document. It scares people away because the additional documentation isn't clear. So it's what I like in guidance that we've seen in the past. This is the Judy view of it. It says you can do this, but I dare you. And I think we just need to correct the record.
Can I ask you a question, Judy?
You bet.
So do you think this could bite the Republican administrations in the backside the way that, if you flip this on its head, right? If you push this argument that you can only look at factors that are materially relevant to the performance of a portfolio in your considerations, and you can't use ethical and environmental and social screens. But then if we can flip it and say, well, but these factors are materially relevant to the performance of a portfolio, does that then open the door to require ESG factors to be considered down the road? What do you think on that?
It could, which is why I say to everyone, correct the record. These factors are financially material. They're not ancillary. They're not collateral. They're embedded in the fabric of our financial analysis. What is challenging is that every factor isn't equally relevant to every company and or every industry. And so you look at SASB's work that has tried to identify factors that are material and relevant by company, by industry, by sector. But we need to make it clear that this isn't something that's ancillary, correct? And we need to not buy into their language because these factors are financially material. They either improve the performance or increase the risk of corporate analysis and corporate performance. And I think now is the time. We have enough data and we need to make that data relevant.
I think that's the number one thing, the last point you just hit on, that we have the data and we need to make our argument around that. Like if you read that, you would think that under ERISA law, you have to pick the cheapest fund available no matter what, and that ESG underperforms all other types of investments. And we really need to show that, as Doug was mentioning, they're a tiny bit more expensive and the performance is a lot better than they're giving credit for.
Great, thanks, Brian.
Megan, I was just going to say, one thing we've learned here in Australia is the power of social media in shifting narratives around this issue. And I would suggest the most powerful way to change the story in the US is to change it through the environmental staff unions of the biggest companies that care, and have them mount that argument internally and have it reach an external audience. And very quickly, the story changes.
Great, thank you. And I think that's a great call to action from Judy. Paul put the link to the DOL comment period in the chat. So if that is something that you're interested in doing, you can click on that and write a letter. We are getting towards the end of our time together, but we had planned on going over a little bit because we're just getting such amazing questions from our attendees. I would like every panelist to give a call to action for everyone here to do at the end of this panel, whether you're just a participant in a superannuation or a 401k or 403b here in the United States, or you're actually the person at your company that is in charge of making these decisions.
I can go first. Yeah, I think that it varies because I don't know all the people that are attending this and, you know, the size of their companies, but, you know, if this is something you really care about, within your own organization, I think you can make a lot of change. One thing that I'm really waiting for is to see how students at these colleges and universities really start to push their administrations, because they have just massive endowments that a lot of them don't do anything that we were talking about. And they have students on campus who care about all this stuff. But I think you can make a strong impact if you get some people at your company. If you're a large company, get a few people and really ask someone in HR, you know, who controls the 401k plan, and let them know that you were part of this group and that there's options out there that exist for making your corporate 401k plan much more sustainable. And then obviously, as Judy mentioned, if you're an American, write a letter, fill out that form that's in the link right now.
I'll second what Brian said for the retirement plan space. You really do need to speak to the responsible party that selects the 401k plan administrator. Often that's a combination of the finance department, like Judy said, and HR, and their safety in numbers. One employee is probably not going to be able to affect the change that you're looking for. But if you can create a working group and work constructively, I forget who it was that talked about that constructive engagement, help the internal experts who pick the 401k plan see the benefit, or if you're in a public fund, help the board see the benefit that the employee engagement aspect has of aligning the retirement plan with people's personal value and belief systems. You know, you can't be a company or an entity speaking about sustainability and then not think about the retirement aspect. And then I think in terms of individual investors, you really do need to find the financial advisor like a Doug that can help you, because as Brian mentioned, so many of them grew up in this belief system that ESG investing is taking a haircut and sacrificing financial return. So don't accept that. The data says otherwise. And if people are telling you that, then they're not educated on the topic and they're not the right financial advisor for you.
And if I could add to what Chad just said, one of the things you can also do is when you're talking to whoever's in charge of your retirement plan is to tell them what a great marketing opportunity this is for your firm to express their values in their investments. And every company that I've worked with, when they've gone to an ESG lineup in their retirement plan, they'll put out a press release and they'll get media hits, and they can use it in their newsletters and talk to their customers and talk to their employees. So show them what a great marketing opportunity it is to get some brownie points with their customer base for doing this stuff, and give them incentives to move it along, and then and make them look good, essentially. Because the problem was when you do this and it feels like an attack, and as soon as you start to attack somebody, they get defensive. But if you can partner, as Chad is saying, with their safety numbers, get a team of your friends, make your HR, your investment advisor, make those people look good, and say, this is a great marketing opportunity, make it very positive, and start there. If you get pushback, you might have to go negative, but that's your last resort. Don't start the conversation adversarial, because it's no one's best interest to go that direction.
They are all very wise words, and it's just so awesome that you guys are, leading this charge. And Doug, I feel like I should send old college friends your way. I always find a wonderful way to have this conversation at a very high level is to just, in a friendly way, point out these were the biggest companies on the New York Stock Exchange 20 years ago, 10 years ago. These are the biggest companies there now. Look at what they represent and understand what they are saying about the planet, about restoring our climate, about using technology for new models, inclusion, gender. And then imagine how wealthy we would be if we had invested in all of them 10, 20 years ago. And start there.
I have two thoughts. One is the comment period for the Department of Labor ends on July 30th. It's not far from here. Please write. First comment. Second comment is please ask. Because I actually went to a group that I used to be part of my large corporate peers, and said, how many, will you share data with me on ESG investments in your 401k plans? Because most of the defined benefit plans in large corporate America are frozen and on a defeasance glide path. So they're just matching the outflows with generally bond investments. So looking to the 401k plans, most will say hardly anyone has asked. So that there is safety in numbers. I would encourage everyone to ask. You don't need to be a genius to say, I think this is something we should consider. I don't think everybody needs to come to the table with all the facts we could give them, but I think everyone needs to come to the table. Because as the masses start to ask, the fiduciaries will start to answer.
I think just another point is, to build off what Judy was just saying, I don't know how many people are on this call, but I bet if you go to your company's website, there's a tab or a section that has something about how sustainable your company is. Everybody's got super sustainable companies according to their websites. And I think that's a piece that you can tie in, you know, it's like, we got to back some of this stuff up eventually.
Great. Well, that is a great way to end the call. I think there have been some hurdles, but just hearing about all the work that everyone's doing has been really great. So for all the attendees on the call, I tried to get to as many of your questions as possible, but I know there were some that weren't answered. So definitely feel free to follow up with the people at ESGX, and I will hand it back over to Paul and Nigel to wrap us up for the day. Thank you.
Thank you so much. Well, that has been an absolutely fantastic and very lively discussion. And firstly, I just wanted to add my thank you to all of the guests who have given, I think, some really useful perspectives and guidance on things that we can all do, should do, you know, right now. Finish this call, go and write that letter, go and ask what the options are within your fund. I just wanted to, or within your company, I just wanted to give a very brief set of observations on this, and then I'll hand over to Paul to wrap up and to talk about some great shows we've got coming up both tomorrow and next week. The first is, you know, there are plenty of options out there to do this. Natixis is doing this with its ESG solutions. A variety of other major investment managers are doing so too. So the options are there. They're proven. This is not rocket science. It is not new. It is a question of simply taking some of those opportunities off the shelf and acting on them. Secondly, it is very much impactful. We had a great story from Maura about what Australian Ethical has done, and not only have they delivered great performance to investors in their funds, and happily I acted on this myself. My superannuation is with them very happily. It's been a wonderful performer, but they're also putting back, and this is some of the community initiatives they're supporting. There's another category as well beyond this. It's also, thirdly, profitable. And we talked about the performance of its fund. Australian Ethical is one example, but its share price performance has been fantastic. We first started working them at Pottinger at the beginning of this chart when the share price was 35 cents. And the advice was, yes, you are clearly undervalued. And if you continue delivering, the share price will grow substantially. And it has performed incredibly well. So all of this is just very profitable too. So sustainability is thoroughly sustainable. Next, we like to have a little bit of a review of some books, and I wanted to flag some things here which are guidance as to what is possible, inspiration that you can act and that it works. Paul Herman's book, The Hip Investor, many of you will know, tremendously useful, to be followed later this year by a book which He is contributing to, and others I think on this panel, also the Global Handbook of Impact Investing, coming out later, available for pre-order on Amazon. Doug's book, Monk to Money Manager, again available from Amazon, and our own book, my own book, The Long Term Starts Tomorrow, all about how you can connect long-term strategic thinking with short-term action, that actually works. I will end my comments by saying that if you have liked this, please do share with your friends, please do post. Every time you hit the like button on YouTube, 10 more people watch the video, so you have power over others through the ether. Please do that. It helps to get our guests' messages out. So thank you very much, and I will hand over now to Paul to wrap things up and talk about what's coming up.
Thanks very much, Nigel. And thank you, Megan, Megan Morrice, very much for curating this conversation about how to green your retirement. We're really grateful to Maura Bunn in Australia, Judy Morrice in the US, Doug Lynam, and Brian from Natixis, and also to Chad Spittler of Third Economy with their new ESG fund ratings launching this month. Of course, Nick Gower is always making sure everything runs smoothly. So thank you, Nick, for making it happen in a productive way. So tomorrow on ESGX, a special tomorrow, is called Remembering Our Origin Stories. So we have a very diverse panel from Native American tribes, from Hispanic backgrounds, of foundations that are spearheading empowerment in Africa, economic empowerment and social empowerment in Africa, facilitated by somebody whose family came over on the Mayflower. So this is in the spirit of Independence Day this month. So please tune in to ESGX live or watch the recording. So that'll be tomorrow, earlier time at 11 a.m. And then next week, very special, the audience is filling up for it. Dr. Jane Goodall will have a welcoming message for everybody, rethinking our relationship with nature. I like to call this Keeping Wildlife Wild, but it's not just about wildlife, it's about people and the earth. And then the CEO of African Wildlife Foundation, Kadu, will be with us. And then a diverse panel working on giraffes, elephants, and photography of nature. So that's next week, July 14th. And again, because speakers from Africa, that also will be at 11 a.m. Pacific. Check your local listing. So thank you very much for joining ESGX, the community for inspiration, education, and taking action. Feel free to share on all the socials, and feel free to share this Green Your Retirement so that we can all invest in a future that we want to live in. Thanks very much. See you next time.